Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and insights you need to navigate, adapt, and lead. Let's dive right in. Government borrowing drops sharply with foreign loans plunging more than 70%, a big move that could shape rates and liquidity in the weeks ahead. The Agriculture Department warns rice traders fake import allocations are circulating, and they're a complete scam. This comes while the rice import ban stays in place until December 31. Labor groups fire back at the government's 500 peso Noche Buena claim, calling it detached from reality as Filipinos face high prices and flat wages. U.S. fresh fruit shipments to the Philippines are surging, up 25%, even as other American exports slow, a clear signal of strong local demand. The government sharply pulled back its borrowing in October, a move that signals both improved cash positions and cautious debt management as 2025 winds down. New Treasury data shows gross borrowings dropped 32% to 87.8 billion pesos, driven by a steep fall in foreign financing. External loans plunged 76%, with no program loans taken during the month. Domestic borrowing rose a modest 8%, supported by Treasury bill and bond issuances. Economists say that the pullback reflects a larger budget surplus, fewer maturing debt obligations, and lower interest costs after rate cuts both locally and in the U.S., giving the government more room to slow its borrowing pace. From January to October, total gross borrowings reached 2.48 trillion pesos, about 95.5% of the full-year target. The budget deficit is now at 1.11 trillion pesos, which the Treasury says remains consistent with its fiscal consolidation roadmap. For businesses, this matters because lower borrowing pressure can help keep local rates stable, support liquidity, and signal that the government is managing its finances carefully amid a volatile economic environment. Now, the Philippines kicks off a crucial week for funding and market sentiment as the government heads into today's Treasury auction, just as rate cut expectations and the country's credit outlook are shifting. Today, the Bureau of Treasury is offering 22 billion pesos in T-bills across 3 tenors, a quick read on short-term liquidity and risk appetite. Tomorrow brings the bigger test, 35 billion pesos in reissued 7- and 10-year bonds that will shape long-term borrowing costs for government and business. Now, investors are positioning ahead of possible rate cuts from both the Bangko Sentral ng Pilipinas and the U.S. Federal Reserve, a combination that could shift yields and capital flows. Last week, short and T-bill yields were mixed, while longer-dated bonds edged higher, signaling that markets want more clarity and growth and governance. The central bank has now cut rates by 175 basis points since August, with a possible 5th cut still on the table this December. Adding support, S&P Global affirmed the Philippines' BBB+ credit rating and kept a positive outlook, citing strong external buffers and progress on fiscal consolidation. For businesses, today's auction sets the tone. The Treasury plans to raise 101 billion pesos this month to help fund the 1.56 trillion peso deficit, a funding push that will influence rates, liquidity, and sentiment as we head into 2026. Now, the Development Bank of the Philippines, or DBP, is moving to tap investors early, signaling how banks may position ahead of expected rate cuts next year. This matters because DBP's fundraising plans often set the tone for funding across the market. The bank plans to raise between 10 and 50 billion pesos in the third quarter of 2026. It's considering sustainability-linked bonds, which could boost funding for green and social projects, but also mean more compliance and higher issuance costs. The offering is expected to carry a 5-year tenor, a compromise between DBP's push for lower rates and investors' preference for shorter maturities. This comes as the Bangko Sentral ng Pilipinas signals possible rate cuts next year, a shift that could lower funding costs economy-wide. DBP President Michael De Jesus expects 4 to 5% growth, but stresses that the broader economy still depends on confidence. For businesses, this means watching where long-term rates settle because bond pricing today will influence the cost of borrowing in 2026. The Department of Agriculture is warning rice traders and millers about a scam involving fake import allocations, a serious issue for businesses that depend on stable rice supply and pricing. The alert comes as the government's import ban remains in place until December 31st. Secretary Francisco Tiu Laurel Jr. says no import approvals have been issued. The fake forms circulating in Cebu claim traders could import rice in December and even tied it to a 2026 food security program. The import freeze, extended through 2025, was meant to protect farmers and has pushed palay prices up to 13 to 14 pesos from about 8 pesos. But for retailers, food processors, and distributors, it also means tighter supply and higher input costs. Industry groups warn of the combination of the import moratorium and lower rice tariffs could tighten supply early next year when local harvests dip, potentially driving up prices for consumers and businesses alike. The Agriculture Department is stepping in to cool a sharp surge in onion prices, setting a 120 peso ceiling for red and white onions starting December 1st. This comes after retail prices spiked to as high as 300 pesos per kilo, a level that hits both households and food businesses. The price cap is meant to stabilize the market amid tight supply, hoarding concerns, and delayed imports. Imported onions are landing at about 60 pesos per kilo. Retailers say they can comply with the 120 peso ceiling once new shipments arrive at around 90 pesos, with Food Terminal Incorporated committing to supplying at that price within 2 weeks. For businesses, especially restaurants, caterers, and food processors, a more stable onion price means better cost planning during the peak holiday season. The DA says that the move protects consumers while avoiding sudden shocks to farmers and traders, and has ordered strict monitoring of import arrivals to prevent another supply crunch. Now, a new controversy is brewing over holiday prices after the Department of Trade and Industry said a family could afford Noche Buena for just 500 pesos. The Trade Union Congress of the Philippines quickly pushed back, calling the statement out of touch with today's high prices and stagnant wages. For businesses, this matters because consumer confidence and spending are already weak heading into the holidays. House Deputy Speaker and Trade Union Congress of the Philippines Representative Raymond Mendoza says that Filipino families should not have to shrink their Christmas dinner, especially while a proposed 200 peso daily wage hike remains unpassed. Trade Secretary Maria Cristina Roque stood by the 500 peso estimate for a family of 4, while Palace Press Officer Claire Castro said final costs depend on choices like cheaper prepackaged items. Mendoza urged officials to stop lecturing workers about budgets and instead focus on making sure people earn enough through lower taxes or higher wages. For businesses, the message is clear. With purchasing power under pressure, holiday sales and overall demand could be softer. Fresh fruit imports to the Philippines are expected to jump 25% this year. The United States Department of Agriculture reports global shipments reached $321 million in 2024, growing 3% year on year. Rising incomes, a young population, and reliance on imports are driving demand. The population could hit 164 million by year-end, boosting the need for imported produce. U.S. exports fell 10% last year and are set to drop at least 7% this year. Apples, grapes, oranges, and plums declined, while cherries, strawberries, peaches, and blueberries gained ground. China supplies 72% of the country's imported fruit. South Africa and Australia account for 9% and 8% respectively. U.S. exporters are encouraged to promote premium varieties like Ambrosia, Cosmic Crisp, and Sugar Bee apples to meet this seasonal demand. Now, after Sunday's anti-corruption rallies from Luneta to the People Power Monument and across the country, markets are watching one thing: whether credibility can be restored fast enough to stop a deeper confidence slide. Right now, capital is cautious, liquidity is tight, and the peso is more volatile than our regional peers. And companies are reassessing risk in real time. Banks see this firsthand through loan demand, balance sheets, and how governance signals are being priced into every decision. Joining us this morning is Eric Luchanco, the Chief Sustainability and Finance Officer of Bank of the Philippine Islands, with a unique view of how people and businesses are reacting, where capital is moving, and what accountability signals will matter most as we head into 2026. Hi, Eric. Good morning, and thanks for being here with us.
Morning, and thanks for having me.
Yeah, Eric, you've got a unique perspective. So we want to see things through your perspective. The corruption scandal has hit the economy in a sense that Q3 GDP slowed to 4%. And it's rattled investors, weakened the peso, really big swings relative to other currencies. From your banking lens, how do you see the state of the economy today?
Yeah, I think the announcement of the third quarter GDP numbers did take the market by surprise. But in spite of that, we've been seeing strong growth in terms of our loan demand. We haven't really seen a significant tail off in terms of the loan demand showing up to the end of the third quarter. And so far, I think it's partly as we head into year end, there's always a lot of activity, seasonality of the activity into year end, and that's driving some of this additional loan growth. But overall, we haven't seen that kind of deterioration in sentiment translate into the loan growth numbers yet.
That's very good to hear. Now let's drill down on loan growth because this is a great temperature check on business sentiment. Let's start with consumer loan growth and then we'll move on to corporate loan growth. Over the last 3 to 4 years, consumer loan growth has been at about double digits, about 20% annually. Where would you say it is today in 2025?
So again, for 2025, and keeping in mind that a lot of the recent developments have only happened in the second half of the year, so we may not be seeing the full effect of it yet. But what we're seeing is 2025 so far has been quite consistent to prior years. So we are seeing consumer loan growth in the 20s, and it seems to be well supported despite what seems to be a bit of a turn down in terms of the sentiment.
Yeah, given that turn down in sentiment, which we really just kind of realized in the second half of this year, what's your outlook for consumer loan growth as we move forward, as we close out 2025 and head into 2026?
I think as we close out 2025, you can probably expect it to continue onward. So we would look to see a 2025 close that is similar to what we saw in the first half of the year. 2026, I think, is maybe a little more variable in terms of the outcomes. And a lot of it is going to depend on how this situation on the investigations play out over the next month or so.
Yeah, absolutely. So for 2025, double digit in consumer loan growth. But as we look into 2026, we'll have to be taking a look at the numbers a little bit more to get a firmer read.
Yes. I think we'll look to still have that consumer and SME loan growth maybe in the 20s.
Okay, all right. In terms of corporate loan growth, over the last 3 to 4 years, that's been at about high single digits, 7, 8, 9% annually. But that's retrospective. How about now?
So far, we are seeing it hold up. But of course, as I mentioned, there is a bit of a lag effect. Like you're saying, it's a retrospective. Loan growth is retrospective. We're looking at what has happened, and sentiment is forward-looking, right? So if things don't get resolved in a manner that people are happy with, then we may see that sentiment translate into reduced loan growth numbers heading into 2026.
Yeah, in a manner that people will be satisfied with. When we talk about the resolution, the fix, how do we fix sentiment? How do we get back on track in a big way? What's the sort of resolution that people are looking for from the conversations that you're having on the ground?
I think it's primarily that we're going to see mechanisms introduced that will allow us to reduce the corruption levels moving forward. And I think that's very important in people's minds, because if nothing changes, then there's going to be real disappointment.
Yeah, real disappointment. Okay, in terms of leadership, that can stabilize confidence. The president says that the situation, Eric, is under control. From the conversations that you're having on the ground, what's the sense of the people and businesses? Do they think that the administration, the president, has a firm handle on this situation?
I think what it is that they generally what we're seeing is that they want to see how things play out, right? I think it's early to say whether we're headed towards what would generally be perceived as a satisfactory outcome. And there's no specific thing that I can say, this is what has to happen in order for people to be happy, right? There are just so many combinations of what can actually happen that we really have to just see how it goes. And but I think if things take a positive turn, wherein we can see real reforms being introduced, then I think you can probably say that the president will have had or brought the situation under control, and that we'll be able to move forward.
And that's
from
what
there.
everybody wants, just to have everything under control, so
Mm-hmm.
so we can do what we need to do. Okay, the S&P affirmation. I wanted to ask you about that. The S&P reaffirmed the Philippines at BBB plus with a positive outlook, despite the slowdown in infrastructure spending. How big of a deal is this, and how much weight does this carry for banking clients?
I mean, it's always good to get reaffirmation, right? And for an external third party, and a very qualified one at that, to be able to say that the Philippines is on decent footing. So it's always good to hear that. In terms of the real day-to-day life, except for the largest corporates that have a tendency to actually tap into the international markets, if you look at the everyday SME or retail customer, it doesn't directly affect them that much. It's more of secondary effects if, when we continue to see expansion, we continue to see FDI investment on the back of this, then there will be trickle-down effects.
So this matters for your largest clients, not for the retail clients. Yes. And for the largest clients, it's reaffirming. It means that, hey, they may not have to look overseas. That day, we're okay. We're still on decent footing. In terms of our global corruption reputation, Bloomberg ranks the Philippines as among the most graft-ridden countries globally, routinely scoring at the bottom of the global corruption index, alongside Sierra Leone and Angola. And the past few weeks have just underscored how deep that rot goes. Are foreign investors right now demanding higher returns, or are they simply looking the other way and not coming to the Philippines?
Generally we've seen Philippine dollar bonds stable in the market, right? And that indicates that there continues to be demand for our paper out there. Maybe the foreign investors are likewise trying to see how things are going to play out over the next few months, how we were able to resolve this situation. But what we're seeing so far is that we're seeing stability. BDO was able to launch a dollar bond last week, and they were able to bring in a benchmark size. BPI continues to see demand from foreign investors, and we believe that if we were to come to the market, that we would see strong demand as well.
Yeah, we're seeing not much of a step back in the fixed income space. It's in the equities market where we've seen that big pullback as people tend to react quicker and really. Can you tell us about that? I mean, what you're seeing in the fixed income space vis-a-vis equities, given where we are today, where the PSE index is today?
Well, we really have seen a step back in the PSE index. It is what it is. We did see a lot of foreign investors exit the market, and that has really dragged.
The peso.
In the last week, we did see kind of a return of some domestic investors into the market, and that's helped us recover some of the losses that we've seen over the last few months. But
the sale was
we're
just
not
too
yet
big.
there, right? Yeah.
Yeah. Okay. This brings us to the peso. What's the foreign exchange market telling you? The peso has been more volatile than our neighbors. What's the FX market telling you?
I think we're, or that FX market is partially affected by what's happening in the equity markets, right? Because as we've seen a lot of foreign investors move out of the market, then they have a natural requirement to move out of pesos and into dollars, and that's weighed heavily on the peso as well. We're starting to see some recovery in terms of the peso, just because we're starting to see more foreign remittances come in, as is typical for this time of year. So we're starting to see a little bit of more strength there, and hopefully we can close the year at around the levels that we are right now.
Okay. Taking a look at where capital is going, as we look towards 2026, what are companies doing? Are they delaying capex? Are they refinancing? What's happening with their expansion plans in this environment and given the political risks?
So 2025 actually started off first half of this year with kind of a resurgence in terms of capex borrowing, right? So companies were coming back to the banks and saying, we'd like to do more, spend a little more on capex, and so we started to see that buoy the loan market in the first half of this year. Things have started to slow down on that end in the second half of the year. A lot of the growth that we're continuing to see has come more from the working capital requirements. And so heading into year end, we think that will also likely be the case, again, because they have to fund the seasonality requirements that obviously, every year the Philippines has a tendency to spend into the year end in the Christmas season. So we expect that to continue. But again, we are seeing a little slower pace on the capex side.
Okay, well, that could be helped by interest rates. The BSP meets, the Monetary Board meets in December. Last meeting for the year. Do you think they're going to be cutting interest rates, and if so, by how much?
Well, if you look at the markets are already pricing in
25
basis point rate reduction. That's also what we believe is more likely to happen than not. The BSP has given signals that there continues to be room to bring rates down further. And we believe that will continue into next year as well.
Okay, easing at least until the first half of 2026.
Yeah, that's probably where we're going to see it.
That's what we need. It's hard now. As CFO, you have to step on the brakes and the gas at the same time. It's how much more difficult has your job become, Eric?
It's been difficult, right? The uncertainty is what makes it more difficult. And so you have to be, in a situation like this, you have to be more nimble, right? You have to say, this is how I think I'm going to move forward, but as situation changes, I have to be willing to make quick moves.
Okay, last question. We're out of time. Does 2026 look like it's going to be a year of recovery or another year of risk management?
I think we're going to start off the year with risk management, and then again, we'll be nimble as the year goes on. And hopefully, if things work out as we hope, then we can quickly pivot and start to become more optimistic.
Well, hoping for the best. Eric Luchangua, thank you very much for your time this morning.
Thanks for having me here.
All right, we're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Welcome back. Well, we don't have the Asian markets just yet. So let's take a look at the PSE index right now. We're taking a look at the PSE index. We're seeing a sea of green. The main gauge is higher by 0.75% to 60.67. Broader all shares index up as well, up by 0.3% to 35.79. Taking a look at the sub-indices, also looking at strength across the sub-indices, with the mining and oil sector up the most, up by 4.23%. Total volume is at 265 million shares, valued at 1.3 billion pesos. Market breadth is bullish. We've got 95 advancers against 43 decliners and 70 stocks unchanged. On the currency front, the peso opened at 58.63 to the dollar, up from its previous close of 58.65. And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BNC, the Bilyonaryo News Channel.